I think the stock market seemed to think that the deal was done and that, we might be kicking a small can down the road. But I think we're certainly going over the cliff, Eric, perhaps because the proposed deal is almost a total victory for Obama and the Democrats. If agreed to, the Republicans can claim a small victory on the estate tax, as you've mentioned, and a small success, I suppose, on the $400,000 marginal tax rate. But spending, the sequester doesn't appear to have been touched and awaits, I suppose, the next battlefield known as the debt ceiling. And so the sequester is still sequestered. To my way of thinking, will Congress be willing to risk $100 billion of defense, education, and Medicare cuts in the next few months or over the next year? I think we'll just have to see. But that uncertainty creates, a different momentum, perhaps, when we reopen the market on Thursday or on Wednesday.
Bill, regrettably, Washington does view these things in terms of winners and losers, and so whatever comes after this will be a battle. What do you expect to come out of these negotiations?
Well, continued dysfunction. I think all Americans are simply beginning not to care very much. It's a dysfunctional organization, this U.S. Congress, that's for sure. And caring what they're going to do would be like asking an equity manager or a bond manager who underperformed the market for a number of years what the favorite stock picks were, the bond picks. And it's the same thing with the fiscal cliff. Even if they produce something, they've reaffirmed their ineptitude. And I think, Boehner and Reid and McConnell, these are a bunch of, sorry about this, but these are a bunch of old politicians without a young and a new vision for the country.
Well, what should that look? You look at this from a different perspective than those people in Washington. Not only are you thousands of miles away on the coast of California, but you're an investor, you're not a politician, and you are trying to bring some fresh views. If you could have them do one thing, Bill, one thing over the course of the next week, the next 2 weeks, sometime between now and when we hit the debt ceiling, what would it be?
Well, obviously resolve this situation in terms of taxes and begin to reduce expenditures. It is a necessary compromise. They have to not necessarily meet in the middle. Obama won the election, but expenditures do have to be cut. Let's look at it this way in terms of the total debt. We have a trillion-plus deficit, but we have, future liabilities in terms of the present value of these liabilities, Medicare, Medicaid, Social Security, of about $60 trillion. That's 400% of GDP. That's an extraordinary amount of money that politicians aren't even willing to recognize going forward. So we've got to begin this journey, and it can't just be simply a kicking the can down the road by Democrats in terms of the sequester or a kicking the can down the road in terms of taxes on the part of the Republicans. Something has to be done immediately. The first and most important fearless forecast is that stocks and bonds will probably return less than double digits and probably less than 5%. I mean, in the bond market, the market itself in investment grade space only yields 1.7%, and so that's not a hard call, I suppose. Stocks in 2013 depend on two primary things: one, real economic growth, and secondly, the Fed. And at this point, Ben Bernanke, to my way of thinking, isn't Rumpelstiltskin. He can only spin straw into gold for so long, and he's been doing that for 3 years now. There's no doubt the QEs will have an effect, but the impact is fading. In terms of real economic growth, 2% or less from our standpoint.
The new normal continues, in other words.
Yeah, it does. There's a number of economic headwinds. It has to do, obviously, with delevering, has to do with globalization, has to do with demographics and an aging type of society which promotes less consumption. And so, going forward, these headwinds, basically limit us to 2% or less growth, and therefore the stock market itself, without the tailwind of the Fed's QE purchases, I suppose, picking up, really only appreciates at 5% or less a year.
So draw, if you will, a connection between the economy, the fundamental underpinnings for that outlook, and what's happening in Washington right now. Is there anything Washington can do to change that outlook, to change that fearless forecast?
Well, certainly, but it'll take time. I mean, our our policy here coming out of PIMCO, Mohammed El-Arian and myself and others, have basically suggested that the fundamental foundation of future growth, comes from education and comes perhaps from, spending on infrastructure and investment. I mean, the problem, Eric, is that, in the past we've spent all of our deficits on consumption. We need to focus that and orient, that towards investment, and whether it's an infrastructure or investment in plant and equipment or energy or any other, particular direction, it has to be less consumption-oriented, more investment-oriented.
So, Bill, I hear people talk about a lost decade, and the new normal, as you see it, continues for several years. At what point, so let's say that Washington takes your advice and starts to do some of the things that you just outlined for us. How long does it take before they begin to influence the way that you look at the world, the way the economy performs, and ultimately the way that financial markets respond?
Well, it takes a number of years, Eric. I mean, it takes the private sector, whether it's the markets or whether it's, corporations themselves or small businesses. It takes the private sector, a determination and a spirited, animal-spirited, type of momentum to, to put this economy back into the hands of the private sector as opposed to the government sector. How long does that take? In the 1930s and the 1940s, it took a long time. It took a world war in the 1940s to produce that type of momentum, and certainly in Japan, as you've mentioned, in terms of a lost decade, it hasn't happened yet. And so, we will simply have to see, but some steps have to be taken immediately in order to at least give us a chance to get there.
Now, Bill, one thing I want to, I guess, go over with you. Your fearless forecasts, we ran through them, and we'll show everybody what they are again. How much conviction do you have in these? Because I've been reading your investment outlooks for a long time, and I know that just about a year ago, you looked at where we were headed as a country, as an economy, as a globe, as a financial market, and thought that we would see similar returns this year to the ones that you're predicting for 2013. And as it turns out, the Fed pumped additional liquidity into the system. We had this risk-on rally that lasted more or less all year long, pumped up stocks, pumped up credit, even pumped up some of the garbage heap assets left over from the financial crisis. So talk to me about your level of conviction. Are you more convinced this year than you were last year?
Well, I think as convinced. I mean, last year, you're right, we talked about stocks appreciating 5% and bonds a little bit less. Bonds have done exactly that. Stocks have appreciated by 6 or 7% more than the forecast. But we also talked about buying mortgages ahead of the Fed. We talked about tips in the form of treasuries, and we talked about buying higher yielding stocks. So, the total return fund, as you mentioned, the largest mutual fund in the world, has gone up by 10.5% this year. Obviously, we've done a lot of things right. Conviction, going forward in terms of this 5% number, I think pretty convinced, Eric. I think going forward that you can't continue to produce double-digit returns from equities, bonds, or any investment, any credit-based investment, simply because the economy and the global economy is limited.
Will the opportunities continue to exist for people like you, Bill? People who, not anybody, I should add, manages quite as much money as you do in the bond market, but will you be able to be as nimble, to be as responsive as you've been this year, to be able to generate a return for your investors that exceeds that sort of 5% cap you see for the bond market?
Well, I think so. I mean, the proof of the pudding is the most recent evidence. Over the past 12 months, we've outperformed the market on the bond side by 600-700 basis points, and that's huge. I mean, PIMCO, as you mentioned, is a $2 trillion firm, and we've produced alpha in the amount of 300 or 400 basis points this year. That's $60 billion worth of added value, coming from PIMCO. So, can we do it again? We've been doing it for 20, 30, 40 years, and we'll cross our fingers. We won't be totally confident, but we think we can.